Hi, this is Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence based holistic insights to help you master the game of building wealth. And as you're probably aware, I'm recording a special series of 8 episodes and release them every Thursday. Talk about how each of the 8 rules in Investopoly have evolved, improved, tightened over the last 8 years between when I wrote Investopoly, which probably 2017, to when I wrote Wealth by Design, which was early this year. And today we're going to talk about rule number 4. So we're almost halfway there, or will be after today's episode. And I think, if I'm really honest, or I'm always honest, if I'm frank about it, the first 2 rules have tightened, not really changed. But a lot of the rules have, I would describe it as a change rather than a tighten. And certainly rule number 4 is exactly that. And I've called this episode the perpetual portfolio, growing your wealth while you spend it, just to, I think, because it really signifies kind of the change between Investopoly and Wealth by Design. And really, a perpetual portfolio is ideal for most people, and I'm going to contradict myself in a second, because it removes any longevity risk and gives them a lot of financial security. Because as you can imagine, if you're spending, even if you're spending a large amount, if you're spending $200,000 a year, but your net worth, your investment asset base continues to appreciate in value over and above inflation, then you feel pretty comfortable, right? You're really in a very strong financial position. So it's a tilt really on the traditional sort of approach, which is build a lot of wealth and then start spending some of that capital and eat into the portfolio until you get to zero, and you hope that you die before you get to zero. That's not a nice thing to think about, but really that's kind of the situation. Now, the contradiction to this is that, I recently did an episode about, not living with regret. So not being in your 80s and having, a huge, or 90s, a huge balance in terms of investment balance, and then look back and think, well, in my 60s, I should have done more. So I guess we need to hold or consider both those 2 observations equally, I think, so you might have designed yourself a perpetual portfolio and then consciously spend more, full well knowing that it's no longer a perpetual portfolio because you're going to spend a lot more for the next 10 years. Or maybe, you spend for the first 10 years or 15 years of retirement, you might spend a lot more and then sort of dial it back. Anyway, the overwhelming point is still, when you enter into retirement, to aim for maximizing absolute return relative to risk. Now, I'll talk about what I said in Investopoly and then sort of counteract that with what I'm saying in Wealth by Design. But really, I think most people's fear is running out of money. I mean, most people's fear is, do I have enough money for retirement? Does that pool of wealth give me the flexibility to enjoy the standard of living and luxuries like travel that I desire? And how financially secure am I? And so, sometimes people go, well, I'm now, because I need income, I'm going to invest for income. Or because now I'm here, I've done all the heavy lifting, I'm in retirement, I can't take more risk, I'm going to adopt a more conservative asset allocation. But unfortunately, both those decisions make the longevity or survivorship risk even more acute. And of course, longevity is a difficult issue to kind of pin down. When you look at life expectancy tables, typically that's median data. Firstly, so it means that half of the people live longer than that. The other thing to really think about is there's a stark difference between people in their 80s today and people in their 50s and 60s today. That's a 20-year difference. That's a generational difference or gap there. But there's a stark difference in terms of whether they've exercised, or maybe I should explain it more as the proportion of those people in that age bracket that have exercised for most of their life, that have educated themselves about healthy eating, healthy living, getting enough sleep, all these sorts of things. And then when you look at the generation even before that, or even the couple generations before that, again, the education just around health, eating, exercise, type of exercise we're doing, regularity of exercise, all come into play. And that's not even thinking then about medical advances and technology and AI and all those sorts of things. So, longevity risk is more prevalent today with financial planning, I think, than it's ever been before. And then the other thing to think about is inflation. 30 years of inflation will really eat away at your balance. So if you adopt a too conservative approach, inflation starts to become the enemy also. And designing a perpetual portfolio attacks both of these or mitigates both of these risks, I think, because the risk of running out of money is much lower. And so what I hope to do today is explain kind of how conventional advice, including really the advice that I had in Investopoly, kind of works against this and how I've improved it over the last 8 years. Okay, so let's talk about what I said in Investopoly, just as a bit of a reminder. I'm sure no one's read that book recently, or maybe some people have. Anyway, in Investopoly, I called rule number 4 as grow your asset base first, then tilt towards income. And I explained it as building wealth in kind of 2 shots, much like I use the golfing analogy where you tee off with a driver and when you get to the green, you use a putter, using 2 different clubs for 2 different purposes. And you're not going to use a wood through the whole course and you're not going to use a putter through the whole course. You pick the best club for what it needs to do. And so, investing for growth, the whole idea then was just build an asset base. And, the other sort of explanation I gave in Investopoly was that if someone walks into my office with a net worth of $10 million in investment assets and says, I need you to design me a retirement strategy, even if all those assets were terrible quality assets, maybe we sell them all and reinvest it somewhere else. But the point is, if you've got 10 million bucks, you're probably okay. There's a retirement strategy there. But if you walk into the office and say, well, I actually don't have any investment assets, design a retirement strategy, I want to retire tomorrow, I'm not a magician. That's mathematically impossible to do. So the first shot to build wealth was all about growth, was about build your asset base first. And then once you had an asset base, then I said sort of tilt towards income. And I talked about using potentially high yielding shares, bonds and fixed interest asset classes, maybe even high yielding property like commercial property. And that was very much a traditional approach, a conventional approach, if you like. But the problem with that is that the taxation drag and the future returns of doing that, you're going to make a sacrifice on absolute return. So, what your investment assets, how they will perform over time. And that's really what's going to prevent you from having a perpetual portfolio. So in terms of what's in Wealth by Design, I think I made really 3 really significant changes to the rule. So the first part of the rule from Investopoly stands, which is the first port of call if you're starting out, if you don't have a lot of existing investment assets in terms of value, then you need to build wealth. You need to build net worth. And the best way to do that is compounding capital growth. Invest in assets that provide most of its return in capital growth so that you don't deal with the tax drag. You don't deal with any fees or cost drag, from changing all the time or receiving income. And you don't need to make a decision every single time, a investment pays you income, because the decision is, what do I do with this income? Whereas if you have a asset that is providing a lot of capital growth that just keeps compounding, all you need to do is have the patience and discipline to sit with that asset for many decades, and it's going to do the heavy lifting. So the first part of the rule is unchanged, and it comes back to that example or analogy I gave you in terms of someone walking into the office with 10 million versus 0, that's the first portal. If you can achieve that first step successfully, then there's an answer there. You've got a retirement strategy available to you. But if you don't do that step, then there's nothing anyone can really do to help you. And then the second part, which was tilt towards income, is now erased. Forget about that. There's really 3 major changes that I made to the second part of rule number 4. The first one is to focus on total return, not income, because that's really the underlying engine of a perpetual portfolio. And at the end of the day, absolute return is what matters most. So I don't really care as an individual investor, and certainly as an advisor, I don't really care about what the return looks like to an extent. I mean, you can give me 10% of income or 10% of capital growth. As long as the return is 10%, it could be 2% income, 8% growth. That I judge a investment performance based on absolute return. Look, the secondary consideration, of course, is tax drag, because if you're going to give me a lot of income and I'm already in a high tax bracket, I'm not going to like that because my after-tax return is much lower. So I want the compounding capital growth, particularly as I'm building wealth, and then also to a large extent, even throughout my total investment lifetime as well. But what I'm sort of saying is absolute return is the focus. And so if you're heading into retirement and you're looking at an asset that's going to give you an absolute return of 15%, but it's only going to give you 1% of income, putting aside risk, saying, let's just assume it's not going to be, but let's just assume an investment with a prospect of giving you 15% in terms of total return is low risk. Let's just assume that. It's not true, but let's assume it. Then as a retiree, I would want to invest in that asset. I don't really care. I can always, assuming the asset's liquid, I can always sell down part of it. So the 15% return is going to fight inflation. It's going to fight, the fact that I'm spending some of the investment monies. It's going to give me a perpetual portfolio. And in terms of inflation, we only need to see what happened during COVID, in particular last sort of 5 years. Okay, inflation's sort of leveling off a little bit, although it seems a little bit persistent. But, if you have a look at what a trip to the supermarket used to cost you in 2019 and what it costs you today, of course, that's a major differential. Now, that's not going to happen all the time, but it is going to happen. The other thing too is to think about bonds. Bonds are always, look at the long-term trends in terms of returns. Bonds are always going to underperform equities. And if you look through the COVID period, because we've had such a rocky road in terms of interest rates, going to COVID, we went to zero interest rates, then we came to high interest rates, then we sort of came off a bit, and now we're back there. That's affected bond returns a lot as well. So, that they used to be regarded as safe. I guess they're safe, and they can be safe depending on their interest rate risk and their duration, so their sensitivity to changes in interest rates. So they can be safe, but at what cost? And are they really performing in a portfolio? And the other thing to think about really is if you start investing in your 30s, 40s, and 50s, that's when you're making your capital contributions. You've got to realize that if you then immediately at 60 or 65 tilt towards being more defensive, so get out of those growth assets, you're actually foregoing a lot of the return. So, if you invest $1 million and earn 7.2% in terms of after-tax returns, or pre-tax, whatever, growth, 7.2% growth means it's going to double every 10 years. So the investment in 30 years is going to reach $8 million, but only 15% of that lands in the first decade and 60% lands in the last decade. So if you make that investment in your 40s and then sell down or change that investment in your 60s, you've missed that last decade where that's where it's going to do, most of the heavy lifting. So the first thing that I've changed is really worry about absolute return. Don't worry about the split between income and capital growth, except for thinking about the taxation drag. The second major change is liquidity. Introduce more liquidity. In fact, introduce as much liquidity as possible into your portfolio, because the liquidity is what's going to combat the lack of income. So probably best I can explain this using an example. Let's say you've got $2 million of investment assets, and that $2 million portfolio only delivers $20,000 of income, which is nothing, right? It's very little income. And you need $100,000 a year to live. So you've got $20,000 of income, but you're short $80,000. If the total return on that portfolio is say 10%, it means in the next year your portfolio will earn, and excluding taxes, will earn $200,000. You only need to spend $100,000. So it means you can fight inflation, and you've got a perpetual portfolio because it'll keep growing. You're only spending 5%, whereas you're getting 10%. Now, if you've got a perfectly liquid portfolio, it's really simple. You get the 20,000 of income and you sell 80,000 of holdings. Now, you can look at it conceptually as I'll sell 80,000 of the growth, but really you would look at it differently, which I'll talk about in sort of the third element of this rule that I've changed. And that's why liquidity is important, because if you've got a lot of liquidity in your portfolio, then you don't need to worry about the income versus capital growth split. So therefore, you're free to make a decision that's actually going to give you the maximum return for lowest risk. And if you're free to do that, most likely you're going to achieve a perpetual portfolio. Now, of course, you should have a buffer in place. So, you should have a certain amount of wealth, be it 1 or 3 years worth of living expenses. It's going to depend on lots of factors, including how much you're spending relative to your asset base, what sort of assets you have, all those sorts of things. But you should have a liquidity pool there of cash or safe fixed interest investments that allows you to fund living expenses for 1 to 3 years without needing to sell anything. So you can ride through a market. 3 years is very conservative. 1 year is probably the baseline. You wouldn't want less than that. So I'm not suggesting that you get yourself in a situation where you've got to make a decision to sell assets every 2 or 3 months. That's not ideal. You do want to have a buffer in place. But apart from that, put the rest in assets that are going to give you the highest return, or the highest return over the next couple of decades. So the third major change is de-risk your portfolio without switching off growth. So in Investopoly, I said sort of change your asset allocation to more conservative income focused investments in retirement. But of course, as I said, that just gives rise to underperformance, longevity risk, inflation eating away at your portfolio, all those sorts of things. So how I've changed the rule now is really de-risking your investment portfolio. And there's a few ways to do that or think about that. I mean, the first one is get rid of unnecessary risk. So things like cutting leverage and interest rate sensitivity. So reducing debt, maybe not reducing debt to zero. It might be economical to hold a certain level of debt in retirement, but you certainly, or at least most of the time, you wouldn't continue to hold the same levels of debt that you needed during the acquisition phase, during the wealth accumulation phase. And you don't want the interest rate sensitivity either, because remember, you no longer have any earned income or business income, whatever you were doing. You're solely relying on investment income, and that's not going to help you weather, changes in interest rates. The second way you can de-risk is liquidity, as I spoke about in this second point. So one of the challenges in retirement with very lumpy unlisted assets is that they can create more volatility in performance, and they can create some challenges because they are illiquid. Maybe if you change your mind and they're no longer appropriate, it can take, one year, maybe even longer to make those changes. So I think illiquidity in retirement adds to risk and reduces flexibility, which is not ideal. The other things you can do are reduce concentration risk. So, if I have a lot of wealth tied up in one particular stock or one particular geographical market, I have one particular asset that makes up most of my investment holdings, that reducing that. If I've got investments that may have performed well in the past, or maybe not, but ones that I'm concerned about their future performance, or maybe they're not invested in ideal ways. So I might have an active managed fund, for instance, and, if you agree with what I write about in terms of rules-based investing, low-cost investing, you might want to change that. So just really thinking about or looking at your portfolio and making sure that, you're reducing as much risk in that portfolio while still giving yourself exposure enough growth. And, the last step then is, as I said previously, build in enough safe assets, fixed income, cash and so forth to ride out any volatility in a market. So 1 to 3 years worth of living expenses there. And I think if you get these 3 steps right, you'll have a portfolio whose total return is more than your spending and inflation, that you can actually draw from with a level of comfort and consistency that will hopefully weather most downturns, not avoid the volatility, but weather those downturns because you've de-risked the portfolio. So just to recap, the first half of the rule hasn't really changed. It's really invest for compounding capital growth, build your asset base first, make decisions so that in, asking yourself 10, 20, 30 years from now, how do I grow my net worth? Forget about income. It's all just about reducing tax and fee drag and getting that compounding capital growth working for you. That hasn't changed. The second half has definitely changed. It's not tilt towards income. It's build a portfolio that's robust, that's liquid, with a bit of a safety net there for 1 to 3 years of living expenses. So as you know by now, probably Wealth by Design out 28th of July. Pre-orders are open if you haven't pre-ordered and you're considering buying the book, or even better, if you know someone that might benefit from the book, get them listening to the Thursday episode series so they get the kind of flavor or introduction, and please encourage them to pre-order the book. Next week, I'm going to talk about rule number 5, another big change there. It's all about asset allocation, a value-aware asset allocation. I've certainly changed that approach or that rule materially as well. And next Wednesday, I've got an important episode about cash flow management using Claude, using AI, and I've got a prompt that I will share with you that you can use, and also talking about automating your cash flow management so it doesn't require discipline. It is a fundamental aspect of wealth accumulation. So really for anyone that hasn't started their wealth accumulation journey, that's a really good one to share with them if they want to get on top of their cash flow management. Anyway, I'll leave it there until next week. Bye for now. Before I go, my new book, Wealth by Design, is now available for pre-order. Pre-orders matter more than you think. They're used by bookstores and online retailers to decide how many copies of the book to stock. So, as a huge favour to me, if you're considering buying the book, I'd really appreciate it if you pre-ordered it now rather than wait. And the part that I'm most excited about isn't really the book itself, it's the AI companion tool that I've built to go with it. I reckon it's a game changer, and I'd love you to see why. The pre-order links are in the show notes. Thanks a lot.